Hey, welcome everyone to our market update webinar. We took a few week hiatus, which was good in the fact that the markets were not going absolutely bananas, at least in the negative. So we want to continue to keep you abreast of what's going on in the overall marketplace, your portfolios, and here what we're up to at Pure Financial Advisors. So appreciate y'all hanging out with us once again. So this is basically for you. Q&A, hit that button, ask any questions that you have. We got, I guess a lack for a better term, a CAM presentation. We have some slides that we want to go through with you. But like I said, this is your time and we respect that. So we want to make sure that if you do have any burning questions in regards to anything in financially, that is, we'll answer that. To introduce myself, I'm Joe Anderson. I'm the president here at Pure Financial Advisors. Brian Perry, he is our director of research, also the EVP. Brian will do the presentation, and then I'll chime in if needed. So it's been kind of an interesting, 10 weeks? It's been 10 weeks, feels like, 10 years. Hopefully all of you are very safe, your family's safe. That's the most important thing of all, because I mean, what's the purpose of cash if you don't have your health? So all of us at Pure, we're working as we normally can. All functions are great. Everyone is still working remotely. All the advisors are working remotely. We have just a very, very small skeleton crew that comes into the office each and every day. So, but if you want more information about what we're talking about, blogs, these webinars, things like that, you can always go to our front page of the website, COVID-19 response. That's where the latest and greatest information. So this webinar will be right there as well. We'll also send you a recorded version of this after we get concluded for today. So the agenda is, Brian will get into, where are we now? And then, there's always challenges ahead. But more importantly, then we'll look at a Q&A for all of you. So I'll turn it over to Brian.
Cool. Thanks, Joe. And yeah, it's definitely been interesting. I've been aging in dog years myself. So, where are we now? And if we just look at a couple slides, we're starting to make some progress, right? The economy is slowly beginning to reopen. We've got a few people going back to work in some places, but it's very much hit or miss. So there are areas, I just saw a chart that Naples, Florida, of all places, more or less fully open, and restaurant capacity has soared, or restaurant attendance has soared. And, and then I heard that in other parts of Florida, restaurants are opening, and in Arizona and the like. And then there's places like New York City, which was one of the hot spots of the virus, which are a little bit slower to open. And then right here in California, where we live, a little bit slower to open too. But, gradually stuff coming back into some sort of normal. The best way I've heard it described, though, is that an off switch versus a dimmer, where when the economy shut down there in March, it was literally like somebody flicking a light switch and everything went dark and everything shut down. And now with reopening, probably more like a dimmer switch, where you have a little bit more control, where it's dark and then we'll gradually begin to lighten the room. But it's not going to be as quick, perhaps, as what we saw on the downside. As far as some of the economics go, I guess the story is, if we look at initial jobless claims, they were puttering along at a couple 100,000 a month, and then they spiked to 1 million on March 22nd. That was the highest reading we had ever had, going back to this data goes back to 1980 or so. From there, we doubled and then doubled again and wound up topping out at 3 weeks in a row of 5 million plus initial jobless claims. So I guess glass half empty is that there are a lot of people out of work today. Initial jobless claims are still at 3.6 million, something on the order last week of 7 or 8 times higher than the previous record. But if we look at the glass half full, the numbers seem to have moderated. And I think that that's a pretty consistent theme. If you look at high frequency economic data like restaurant bookings, travel bookings, stuff like that, we're starting to see some sort of stabilization and perhaps recovery. Though I don't want to sugarcoat it, the economic decline is unprecedented since World War II, certainly. And in conjunction with that, I think it's important to realize that the stock market is a leading indicator. And so stocks fell sharply, as you're all aware, in February, late February into about the end of March, and then rebounded quite a bit. And we've more or less been going sideways with some bouncing around since then. So if you look at the S&P on the left-hand side over the last year, despite all that we've gone through and the interesting times and stuff, we're right about where we were a year ago on the S&P 500, which seems rather remarkable to consider. However, I don't want to sugarcoat things, because certainly we could be in for continued volatility. And even just in the last couple of days, we've seen that as stocks rallied furiously yesterday on hopes of a coronavirus vaccine. And then I guess towards the end of the day today, some less positive news on that drug came out and stocks sold off 300 or 400 points. So, my suspicion is that we're going to continue to see volatility. We could even see, some lower prices and stuff like that. So I think it's time to buckle up. But I think that these historical pictures are helpful in looking at, despite all we've gone through, we're where we were a year ago. And if you look on the right-hand side at the S&P over the last decade, pretty sharp decline, pretty sharp rebound. But, it's still a pretty good run over the course of 10 years, despite all that we've gone through. And then just one more asset class I want to point out, because it got a lot of press, is oil. And oil is obviously a key part of the economy. And so as the economy began to shut down and people weren't flying or driving, you saw prices collapse. And, this chart reflects actual negative oil prices, which was a little bit of a technical event. But the reality is that oil prices fell from like $60 a barrel down into the single digits or so, have since tripled. So we're up into the 30s now. So still pretty low prices. You're probably, if you're venturing out yet to drive, you're noticing that prices at the pump are relatively attractive. But overall, I think that this rebound in oil prices is healthy, because it does reflect an economy where people are beginning to get up and about. So, the idea is, I think that, again, we've hit rock bottom in all likelihood in the economy, and now it's about where are we going to go from here. And so there are some shorter term things to consider and then some longer term. On the shorter end, I think the big question is, when will we have a vaccine? Again, yesterday, some of the trials sounded pretty promising, and then I guess what I heard today is that they weren't as good. But when will we have a vaccine? I wish I knew the answer to that. I don't think anybody does. And then beyond that, when will it be readily available to everybody? Because, in all likelihood, for things to get back to the life that we all knew at, let's say, I don't know, New Year's Eve or something like that, we probably need most people to be vaccinated and everything to be fully open, and mass gatherings and the like. So the answer to number one there of when will we have a vaccine probably holds into number two, which is how long till we are fully open. My guesstimate is that we'll continue to open and that things will get closer to normal, but that we'll probably need a vaccine for things to be fully open in the sense of mass gathering, football games and concerts and the like. And then as we dovetail into when will the economy recover and when will the bear market end, I put this slide together a couple of weeks ago, and I just wanted to highlight a couple things. There's some good things going on that are supporting the economy, such as lower oil prices, like I mentioned. The decline in interest rates is helping spur mortgage refinancing, and as more homes become available for sale, potentially home purchases. And then there's just been a ton of government support. And, there's a lot of bad news and stuff like that, too, with so many people out of work and small businesses struggling to reopen. And what in the long run, and we'll talk a little more about this, does this COVID-19 mean for globalization and jobs that are going to disappear? But I really think that the robust government support has played a huge role in if not cushioning the economy, at least keeping it from completely collapsing. Because for a while there, when nobody could leave their home, really the only spending going on was the government and then people ordering from Amazon or going to the food store. So the actions of the Federal Reserve and some of the congressional support definitely help prevent this from being a Great Depression type scenario. And I've heard people talk about whether or not this is a depression or not. And there's no official definition, believe it or not, for a depression. But usually it's defined as a recession that lasts for a long time or is more severe or more widespread than a regular recession. Whether or not this ultimately gets classified as a depression, I don't know. I mean, I'm seeing estimates of the economy, the economic activity being down 35, 40% or so this quarter, which is the most that we've seen certainly in our lifetimes. But I think what makes this different than the 1930s is a couple things, and these are all good things. One is the degree of tools and the willingness to use them that the government had. The second is that the financial system, even if you just compare it to 2008, was in reasonably good shape. And so luckily we weren't leveraged and taking on the kind of risk we were in 2008, or I think this could have been, we could have been in even more trouble than we are right now. And then the third thing is just that Americans and people around the world have more disposable wealth and more savings than they did if you look back 70, 80, 90 years ago. And so, people are a little bit able to, continue to eat and continue to keep the lights on, even being out of work. And so, certainly a struggle right now with the economy, but we're moving past, I think, the darkest point and looking to what things might look like as we reopen. And the conference board back in the beginning of April put out 4 possible scenarios, and I just want to touch on these, and then they've updated this. And so they put out a couple recovery scenarios. One was a May reboot, which was essentially that economic activity started gradually picking up in May, and we were really kind of back to normal by summer. The other is a summertime V-shape, which is that we've declined quite sharply, and then we bounce back strongly with a peak in new coronavirus cases in early May, and then a really strong recovery starting in midsummer. And then 2 more scenarios. One was where we kind of get back to life as we know it, but then the coronavirus returns with a vengeance back in the fall, and we have more of a W shape where we fall, we recover, and then we fall again. And then the 4th scenario they put out was an extended contraction, which they call a U shape. And here, we essentially flatten the curve with some of the government policies. That's the good part of it. The bad part is that economic weakness gets extended into the summer. They've since come out. So this was April 9th. Since then, the conference board has come out, and the U shape is now their base case, is the one that they think is most likely, is that we'll have a prolonged recovery here. And so the idea here is that the worst of the decline is probably over, and the pace of decline is moderating and in some cases stopping and reversing, but that it could take a while as, again, that dimmer switch gets turned on and the economy reopens before economic activity is back to normal. And, we heard Jay Powell, the chairman of the Fed, on, I believe it was on 60 Minutes this weekend, say he thought maybe the end of 2021 before we fully recover from what's going on. The couple things, though, that I think are important to keep in mind is, again, I think the worst of the economy is over with. It's just really now kind of gradually recovering, and we're going to see some significant increases in economic activity. They may just not be back to as high of a level as we were in January or something like that. Same thing with the stock market, right? There are different kinds of bear markets. And again, we've talked about this a little bit in the past, but I want to continue to kind of focus on the idea that there are structural bear markets, which are the most severe. This doesn't seem to be one of those because the economy and the financial system were structurally sound leading into COVID-19. But then there are cyclical bear markets, which are more driven by the economic cycle, and then event-driven bear markets, which is a one-off like a flash crash or a 9/11 type thing or something like that. Clearly, COVID-19 is an event, and it drove the economy or the stock market into a bear market. We fell more than 30% in about a month. The key difference here between the event-driven and the cyclical, as you can see, is how long the event-driven bear markets last and how long they take to recover vis-a-vis the cyclical. And this will be something to continue to watch, is how long the stock market takes to recover. But again, we've had a really healthy recovery. And, I think that the degree of snapback that we've seen is one of the reasons that your advisors are always telling you to stay the course. It's that, as dark as things seemed for a time there in March with 1,000 and 2,000 point declines and a 30% decline in the course of a month, look at the rally that we've had. And again, I'm not convinced that we're completely out of the woods and that we won't get more volatility. So I want you all to buckle up and prepare for that. But just if we do fall again, we could bounce back just as sharply. We've had a 25% recovery in the last couple months. And for those that might have not been able to stay in their seat, they've missed out on that and locked in losses. And so, I think that the last couple months here have been a really good live example of why your advisor here at Pure, and you'll see in the press and stuff, the guidance to stay the course and stuff like that. Because who knows? Who knew that back in mid-March, as stocks were plummeting, they were putting in what was at least a temporary bottom, and the Dow Jones since then has gone from like 18,000 to like 24,000. So a really significant increase in that time frame. But again, buckle up for continued volatility. And that's the short term. Longer term, I think that there are some impacts as well. And we've started getting questions around these. And I don't necessarily claim to have the answers on these, but I think that this does, COVID-19, seem to represent maybe a demarcation in our society. And I think that anytime something like this happens, behaviors do change, sometimes permanently. If you think back to something like a World War II or something like that, I don't know, the Spanish flu, other important times in history, people's behaviors in some ways change. And so whether it's less social gatherings, more use of video technology going forward, maybe some companies don't bring all their workers back to a physical location and there's more remote work and stuff like that. I think that there will be permanent behavioral changes. And what that's going to mean is that there are businesses that don't fully recover. And there are workers whose jobs might not come back. And that's always a painful process. And that's the whole really the foundation of capitalism is, I've heard it called destructive creation, is that you get these jobs or these businesses that get destroyed and then get replaced by new winners. And it can be a painful process. We're doing this webinar right now over Zoom, and what a valuable tool for so many people Zoom has been. A technology that probably nobody would have considered 10 years ago or even a couple years ago has been fundamental to the way that we all conduct our businesses and our lives here in the last several months. That would be an example of a winner in this environment, whereas there are other businesses that won't come back. And one of the keys that we do, and one of the reasons that we preach broad diversification, is that, again, we lack the crystal ball and frankly don't know anybody that has the crystal ball to pinpoint exactly which companies will and won't win and exactly how people will collectively change their behavior. We want to make sure that we're represented in the winners as well as hopefully minimizing the share of the losers that we have in portfolios. And then finally, state and local finances are strained, and, that's going to have impacts. We'll see what happens here. There's $1 trillion written into the latest House package for support for state and local governments. But certainly, for the most part, particularly in California here, again, where we're located, most local governments generate their revenues from property taxes and from sales taxes on things like cars and stuff like that, big ticket items. When those two items fall significantly, it severely impacts local finances. And I've started hearing some talk about, I know a few people that have been furloughed or have, or getting their days cut at work in some of the public entities. And so, that'll be something to monitor going forward. And then I think the bigger one, and this is a question that we get almost every time we do one of these, is the national debt. And so I just want to spend a couple minutes talking about this. And this is a chart of the national debt in trillions of dollars since the early 1940s through today. And you can see really the sharp increase after 1980, and then particularly after about 2000, where it started to go up. And then it's kind of just going up more and more steeply and has skyrocketed recently. And, just to be clear, again, I think that a lot of the government support has really kept the economy moving and supported the economy and has been necessary. To me, it's a triage effect where when the patient is really sick, you do what you need to and worry about the longer term consequences later. If anything, maybe some of the deficit spending back in the 2000s or the 2010s, where the economy was doing pretty well in the last decade, wasn't necessary and contributed to the national debt unnecessarily. But I think a lot of the spending recently has been necessary and vital to keeping the economy going. But nevertheless, 25 trillion is a pretty big number for the national debt. So then we focus on a couple things. One is how big is it relative to the economy, right? Because we have a lot more debt than we did in 1980 or 1950 or even 2000, but the economy is also a lot larger. So I think when you just see the headline number, it's important to keep that in perspective. The other part is how much does it cost to pay the debt, right? Is how much is your interest rate? And right now interest rates are very low. So the cost for the government to finance the $25 trillion debt may actually be less than it was to finance a $10 trillion debt 15 years ago, right? And so I think that is the two important things, just like on your personal balance sheet. If you have $100,000 in debt and a $5 million net worth, that's probably not as big of a deal as if you have $100,000 in debt and a $200,000 net worth. And then obviously the more interest you're paying, if it's credit card debt versus home equity or something like that, is going to impact your ability to finance it. So right now, the national debt doesn't worry me. I think that it's a longer term, potentially an issue. I come from a bond market background, and so the bond market is really closely linked to the debt and whatnot. And I've been getting questions about this since I started in this business 25 years ago, people concerned about the national debt. And the one thing I will say is, to date, it hasn't necessarily been a huge issue, but I'm also reminded of, I don't want to be too cavalier about it, because I'm reminded of the line from Hemingway in The Sun Also Rises, where the one character asks how the other character went bankrupt, and the character says, two ways, slowly at first and then all at once. And I think that with deficits and debts, that's usually the way it is, where it's not an issue for a long period of time and then suddenly it becomes a big issue. So certainly something to monitor, but not something to be too concerned about at the moment. And then, we're big believers, and I'll kind of wrap with the next two charts, is we're big believers in controlling what we can control. And so it's like with the national debt, there's really only four ways to get out of it. And the government could default on their debt. And I don't believe that's going to happen. And if it does, then I think that we all have bigger problems. You can grow your way out of it, which is the best, is if the economy expands rapidly enough, you can grow and those tax revenues will then pay off the debt. But I think the two most likely ways are you can either inflate your way out of the debt. And here we have a chart of the inflation rate since 1920. And you can see that, I don't know, the last 20 years or 30 years have been pretty moderate there. And right now we have very low inflation. So it's like, okay, could you inflate your way? Could the higher inflation mean that more dollars, less valuable dollars are paying off the national debt? And sure. And so it's like, okay, well, from a planning and portfolio perspective, what can we do to protect you against that? And we can do a couple things. We can use relatively conservative inflation assumptions in your financial planning, which is something that we do. And then we can hold asset classes in your portfolios that we think have a good chance of keeping pace with inflation. And even if inflation increases, we think we'll do well. And those would be things like stocks and some of the certain kinds of bonds, and then some of the natural resources, all of which tend in the longer run to do okay if inflation rises. And so, we're doing what we can in this instance too, if inflation goes higher, to protect your portfolios from that. And then the other, obviously, potential way to get out of a deficit or debt situation is to tax your way out of it, right? And, as many of you know, taxes are at all-time lows. They're scheduled to go higher here in a couple years. But who knows? I mean, the government spent trillions of dollars trying to cushion the impact of COVID-19. The debt is at all-time record levels. Could taxes go much higher over time? Certainly. But again, we don't have control over what the government does with taxes. We do have control over the tax planning, and I think that points to the things that we're controlling, which are, to the degree possible, how can we structure your portfolios for tax efficient distribution in the future? How can we put a relatively conservative inflation assumption into your financial planning? How can we build a portfolio that we expect to keep pace with inflation over time? So again, national debt, and I'll summarize with this, I think one of the key longer-term impacts of COVID-19 will be the national debt, but I don't think that in the short run it's a tremendous issue. Longer term, there could be some impacts, but we're doing what we can in order to make sure that regardless of what happens with the national debt, regardless of what happens with taxes, with inflation, we're positioning you for success. And with that, that's a lot from me, so let me pause and see if Joe has anything or weigh in with any questions and answers.
Yeah, Andy, do we have any questions from the group?
We certainly do. Bob would like to know, quick overview of the new rules associated with rolling an IRA to a Roth IRA. Is there a case to make this move?
Okay, well, the CARES Act, it's something that's called a CRD, or a coronavirus-related distribution. And if you take that distribution in 2020, you can take up to $100,000 out of a retirement account, and you can potentially pay the tax over 3 years. So for instance, say you took $90,000 out of the account, $30,000 of income would show up this year, $30,000 would show up the following year, and then $30,000 the third year. You have to qualify to do a CRD, and the IRS has a pretty broad definition of that. Like, you need to be diagnosed with COVID, a spouse, a dependent need to be diagnosed with COVID. You had to have some adverse financial hardship in regards to maybe reduced hours, furloughed, laid off. Small business owners, right, if you got shut down, let's say maybe you had to stay home and take care of dependents. And then the final one is something interesting where they put in, it was like, well, any other thing that the IRS deems okay. So what a lot of people are saying is that, this is a pretty wide definition, and that most people would probably qualify for the definition to take a CRD or coronavirus related distribution. But to answer your question specifically is like, well, does this make a case for me to take a CRD and then convert that into a Roth? So there's 2 points. One, the law does not prohibit, as of right now, for someone to do that. But was that in the spirit of the law? Absolutely not. The spirit of the law was to allow people to take money from a retirement account to either pay it back over 3 years or pay the tax over 3 years to ease the cushion if they needed to utilize some liquid assets from a retirement account. So us as a firm, we're not looking to use that to do conversions. However, I think it does make sense for those of you that qualify to utilize that and put it into a brokerage account, because then you can tax manage that maybe a little bit more appropriately, and it's more of a cushion versus the IRS could come back and say, hey, this could, there's arm length transactions. It could be a sham transaction. They could revert it back, 100% taxable. And we're too conservative. We don't want to like play on that fine line. But I think it's appropriate for people that do qualify to take dollars out of their retirement account, of course, depending on what tax bracket that they're in now, what tax bracket that they're going to be, how diversified they are from a tax perspective. Because my true belief is that tax rates will go up. And if a lot of your dollars are sitting in retirement accounts subject to those higher rates, does it make sense to get it out of the retirement plan now and put it into something more tax efficient? I think a brokerage account, because if you do need to utilize the assets, you have access to it. So yes, so by converting it directly into a Roth IRA, as of today, we're staying no, just because of how, the CARES Act came out really quickly. And just in the spirit of the law, most of the experts are saying that we look at are like, yeah, you can do it. There's nothing saying in the law that you can't. But we believe that it's probably not in the spirit of it. But by taking money out, putting it in a brokerage account, I think would be a little bit more suitable.
Next question is from John. Is this a good time to invest in a primary residence, or should I remain in my rental?
Is it a good time? Well, so he's renting, yeah. And should I buy? Well, interest rates are pretty low.
Yeah.
So it could be a good time to buy, depending on if you find the house that you want to live in long term.
Yeah.
So
not a lot of supply though, on the other hand, because if you don't have to move right now, why would you list your house for sale when you can't even leave your house? So probably pros and cons.
And it's funny. It's someone here sold a house all virtually, and I think the thing closed, in 7 days. Right? People are looking at it via Zoom, and sight on, bought it sight unseen. Is that the right terminology? So yeah, it really depends on your specific situation, but maybe with interest rates as low as they are, the housing, it's pretty expensive to live here, as we all know. Yeah. So that helps, I guess, with cash flow getting in at a fairly low interest rate.
The one other thing I'll throw in on that, and I don't know, I'd have to double check on this, but I know as of, maybe a month ago, it was not really feasible in a lot of cases to get a jumbo loan in San Diego or anywhere for that matter. And jumbo loans are defined as anything under $700,000. So it just depends again on what kind of house you're looking for and what kind of mortgage. But, given house prices in San Diego, that's something to keep in mind is before you do too much looking, you might want to see what kind of mortgage you can get because of with some people not having to pay their mortgages right now because of some deferments and stuff like that. There was a hesitancy in the mortgage market to lend more than that. And there was a little bit of a breakdown in that portion of the market.
Okay, as a reminder, if you have a question, just tap the Q&A button and type in your question. Craig has a couple of them for us. First one is, how will COVID-19 impact the November election? And if Biden wins, what financial and economic changes can we expect?
I honestly don't know the answer to the first one because I think it depends on what happens here with the economy over the course of the summer. I think if the economy roars back or even snaps back relatively strongly without a surge in deaths, I think that's probably a positive for Trump because he can say that he navigated through it, managed to minimize the death toll, and then rejiggered the economy or got the economy going again. If we come out of this much more slowly from an economic perspective, or there's a resurgence in COVID-19 deaths, and I think that probably hurts Trump. Like it or not, my guess is that to a large degree, his re-election hopes are going to come down to this is going to be a referendum on how he handled COVID-19. As far as the impact if Biden wins, it's funny because there hasn't been that much campaigning going on just because of COVID-19. So I haven't heard that much lately about what he would or wouldn't do. I think that to me, from a market and economic perspective, a lot of people would say that the worst case outcome was Bernie Sanders winning. And that's with that off the table, I think that markets are very relieved about that. Now, recently, yesterday, I saw talk of, potentially a path for Elizabeth Warren to be vice president, and that I don't think markets would like. So I think the stock market and the economy, at least out the gate, can live with Joe Biden as president without, kind of throwing a temper tantrum. But it'll be interesting to see who he names as his vice presidential candidate, because that could sway things one way or the other.
Craig's next question is, how will the impending insolvency issues with Social Security be impacted by the high national debt?
Yeah, that's a really good. That's a really good question.
It's not going to help.
That's above my pay grade. I don't know. I mean, I think what right now how it states is 2035 is that the trust fund for Social Security runs out. Stating that doesn't mean there's not benefits. 85% of the scheduled benefits would be paid. So there'll be something that happens with Social Security. They'll have to, but it's always the last minute, right? Yeah. So there's still time. But then I'm also seeing that more people are claiming early because of this. So what is that going to have an impact on? What are the cost of living adjustments moving forward in regards to your Social Security benefits? What potentially could be the taxation right now? Up to 85% of your Social Security benefits are subject to income tax. The state of California does not tax them. Could that change? So, they're looking at maybe potentially extending the full retirement age, from 67 to 70. So there's a lot of moving parts there. It's very difficult, I think, to pass anything with Social Security when it comes to Social Security reform, because it seems, it's a political nightmare, right? As soon as someone talks about it or wants to do something, because most of the voting public are closer or collecting Social Security. So sorry, I don't have a better answer for you, but there's a lot of things that happen, and I think it's just being abreast of kind of what the word is out there and designing the plan appropriately.
All right. John would like to know, if the virus surges again in the fall, and if it is worse than this spring, what will be the effect on the market?
It will blow up.
Yeah, it won't be good. We could probably expand on that, but yeah, it's not going to be good.
Yeah, I mean, as you can see, the market dropped 30% a couple of weeks. And if it's worse than expected, you're going to see it drop, because it's not news, or it's not good news or bad news. Is what always is the difficult thing in regards to investing. It has to be as good or as bad as expected. And so if it's worse than expected, you're going to see the markets, become extremely volatile. But even if you get really bad news, but if that bad news was expected, you're not going to see the markets move at all. You're going to be like, well, what the heck? All I'm hearing is bad news when I'm watching, the news or listening to whatever. But if the news isn't as bad, even though it's terrible, terrible news, I mean, a ton of lives are being lost. A lot of small businesses are totally out of business that will never open up again. I mean, this is really trying times. But how the market works is that, okay, well, even though with a plethora of terrible, terrible news, if it's already priced in, if it's already expected, the markets aren't going to move. But once it hits that needle where it's worse than expected, then that's when you'll see a lot more volatility. So, or if it's better than expected, because they've already priced in that things are pretty bad. Right. And that's why you're seeing a recovery in the overall markets, is because the first month it's like, oh, who knows what's going to happen. So let's just price everything in that it's going to be, really, really bad for a long period of time. And then as you see things come through that are a little bit better than expected, then you see some jumps. So that's why it's so difficult to time markets. Because it's not necessarily you can trade on the news, but the news has to be as good or as bad as expected. And that expectation is a collective of the overall market itself. So it's trying to compete against that is challenging. So how we look at it is want to position, our portfolios defensively from a defense perspective, because most of our clients are retired or close to retirement. They want a preservation of capital. They don't want to take on huge risks, but they want to get a certain target rate of return that outpaces inflation and taxes. And we design the portfolios very specifically to each of your overall goals in regards to, retirement income demand from the portfolio and looking at taxes, your Social Security, pensions, and et cetera. So yeah, if we see a surge coming up in fall that's worse, but if it's already priced in, you're not going to see a lot of movement. But if it's worse than expected, it's going to be extremely volatile. But that doesn't see it could bounce back in a month like it did here as a vaccine comes through or whatever.
Yeah, that's what I was going to say, is that just because it starts falling again doesn't mean it's not going to bounce sharply. And, the one thing, I don't have any kind of crystal ball, but I was talking about those economic scenarios. I think we'd all rather we're probably all sick of staying in the house, right? And want to get out and do things, and we want the economy to recover. But some of those V-shaped scenarios where we started the economy again in a hurry, I think increase the possibility of a second wave in the fall, where the idea of gradually reopening it makes it a little bit more painful now and maybe extends out that pain. But all else being equal, it's also significantly reducing the odds of a second worse wave. It doesn't eliminate it, but it does reduce the possibility of it.
Libby would like to know, has there been much discussion of a value-added tax to repay the national debt?
They talk about that all the time.
Yeah.
Big Al was on the call. We talk about that quite a bit on our podcast. So I haven't heard a lot of whispering from that, but I think Alan's been a CPA now for 70 years. So I'm kidding, Al.
He's going on what? His 90th birthday is coming up.
If you're on the call. But no, we are value add tax. Often there's nothing, in the horizon, but it wouldn't shock me. I mean, I think with our tax system, with the marginal tax rates as low as they are, who knows what the future brings in regards to taxation.
And then Susan, my friend Susan. Hello, Susan. She says, what does and doesn't keep you awake at night?
I sleep pretty well, but, I think some of the things that the thought of a second wave that's worse than the first is something that to me is troubling. If we get back to some sort of normal and then have to go back into our homes, I think that would be a pretty bad scenario for the markets.
And I think a really bad scenario just for our psyche.
Yeah.
Right. It's, if it's the right thing to do, of course, lives are more important, but it's almost like if you're on an airplane and you have a 4-hour flight and then you look at your watch, you got 10 minutes to land, and all of a sudden, they're like, oh, well, just kidding. We're going to be on this airline for another 10 hours. I mean, I think people would go absolutely bananas, right? So it's kind of the same thing. If it goes, and we have to go back and shelter in place and all of that, which could happen. That keeps me up.
And the other thing is that, and Donald Rumsfeld, and I don't quote him often, but he said that there are the things we know we don't know, and the things we don't know that we don't know. And it's the third one there, I think, that is usually the knocks us off our rocker. I mean, think about it. Coming into the year, anybody on this call could have listed their top 10 concerns for 2020. I guarantee COVID-19 wasn't on anybody's list, and it's turned out to be the biggest economic basically declined since World War II, and the market fell 30%. So, for me, it's not so much that keeps me up as the things I can imagine. It's the things I'm not thinking about that are a knock-on effect from COVID-19 and shelter in place that are maybe the unanticipated consequences. I think those are usually the most damaging. And obviously, by definition, we don't know what those look like ahead of time.
Yeah. And some people probably won't. I mean, you see the protests now.
Yeah.
So.
And that's all the questions we have.
All right. Awesome. I think we ended right on time. So we really appreciate all of you joining us here. If you do have any more questions, thoughts, comments, you can reach out to myself, Brian, or your advisor. We are here to serve you, and we really appreciate your confidence in us and our firm. We are moving strong, and we again, hopefully you are very healthy and happy as much as we can be, and we'll see on the other side of this. Hopefully we can see you all in the office here real soon. So thank you all again for joining us, and we will talk to you soon. Have a wonderful day, everyone.